Well, November's been a super strong month, both for equity and fixed income, with the Nasdaq up 10% year to date and the 10-year coming off about 50 basis points from those recent highs. But after the US CPI prints, have markets got a bit overzealous with the level of rate cuts that are being priced in? Are we fair to say that we're going to be running short US dollar positions into year end? And as sell-side banks and investment banks put out their 2024 outlooks, can traders get any informational advantage from this whatsoever? It's time to get in front of the charts. This is the trade-off. Well, hello. My name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined by in 2 seconds by Blake Morrow from Forex Analytics. And we're going to be looking at the charts, we're going to be looking at the key themes, the views, the movers and shakers that are going on in this crazy world of financial markets. Mr. Blake Morrow, would you step into the show? How goes it there, sir? Slightly different background today. I think you call that a canal.
That it is a canal. And, you know, people look at that and they say, wow, that's pretty water. It's a canal, folks. Don't get too excited about it.
Is that far from your house?
It's just a few miles from my house. That's in Old Town Scottsdale. It is. It's amazing what you can do with a cement canal and how pretty you can make it look.
Yeah, I'm sure. How's the market trading at the moment? Are you guys enjoying the market conditions, the trading environment you're in at the moment?
I like it. I was able to capitalize on it earlier this week. I was long some sterling, basically short some dollars, following CPI. But today's episode is really going to be more about what we should do now, because it's great. And I got to point out, Chris, you asked if I'm enjoying the environment. You have been sitting here for the last 2 weeks telling people, hey, things are turning bullish, and we've been talking about bullish setups. But now, as you pointed out, 10% for Nasdaq on the year.
It's getting too hot. Is it too hot?
What do you say? Yeah, what do you say here?
I don't know. Well, let's debate it. Let's go straight into the show, actually, because we can talk about this exact theme. Let's go into Topical Thunder. Well, let's bring it in. I mean, 10% month to date Nasdaq. I mean, I think there was a time it was up 10 out of 11 days. We've got to a point where real rates are sort of consolidating after pulling back. The 10-year dropped 50 basis points from those highs. The reaction in the CPI print was pretty emphatic. I think it tells you a market that was short duration, and I think they basically came out and said that it's done. Fed, you're over. You are. The distribution now has moved to one where it's extended hold and then cuts. Hikes are completely off the table. It's not going to happen. We shouldn't even be talking about them. And the market rejoiced. But has sentiment got too hot here, Blake? And do you think that you probably take a little bit off the edge? Where does the balance of risk lie for you across various markets? What markets do you like as well?
All right. Well, first of all, like I said, I think it was the move was obviously very strong, and we're going to be debating on what we should do from here. The question that you ask, are you feeling it? I don't know if I'm feeling it. I can't say that I'm feeling it. I understand it, and I tweeted something yesterday. At the end of the day, I'm like, it just simply, you can really understand the market poorly positioned. Everybody was expecting the Fed was going to be a little bit more hawkish. The data is still going to be hot. Here in the U.S., we have Middle East conflict. There's going to be a meeting between China and President Xi and Biden today, matter of fact. And everybody is just kind of bearish the markets overall. And I think it was just positioning. And then what goes back to FOMO, the term that I like to say coined, but
I didn't coin it.
You didn't coin, but no. the fear of underperformance, right? And now you got everybody that was short, they're underinvested. So I think positioning was just way out of whack, created a massive squeeze thanks to the Treasury and all these other events, and the FOMC, then the CPI, the tamer than expected CPI. I mean, it was just by 0.1% on pretty much all the readings. So it's not like we saw super deflationary numbers, which would have elicited a much bigger move. But the question is, do we chase these markets now? And like you say, you asked, am I feeling it? Not necessarily. I understand it, but what I want to do from here is a little bit different, and I think we're going to be discussing that today.
Well, I think the great thing about us as traders relative to investment managers and specifically active, because you bring up this concept of FOMO. For us, we just got to make money, right? We've got to protect our risk, get our position sizing correct, and try to grow the capital in our trading account. That's what we've got to do. But for active managers who are getting paid a performance fee for beating a benchmark, I mean, how good is it that we don't have to do that? If the Nasdaq's going up on very concentrated breath, and right now we're actually seeing some rotation into financials. That's working well. Short covering stocks, short high interest stocks have seen some big short covering recently. But these guys, they can't have an opinion on the market. If it's going up and they're a couple of percentage points below, and they've got to chase it, and they've got to be in the market, and they've got to get the right stocks to outperform the benchmark. It's why they get the big fees that they do, and lucky for us, we don't have to do that. We just got to choose whether we want to be in it or not, but we don't have to outperform a benchmark.
We don't, and you make a great point, but I think for us as traders, understanding where the market's at right now, and that's the key right at this moment in time. The market has rallied. We've rallied 10% off the lows in the S&P over the last 3 weeks. Do we chase the markets? But before we actually answer that question, let's go to the next topic, and I want to talk a little bit about rates. You're the in-house Pepperstone in-house rates specialist, but this is it's a little crazy. I mean, I sit here and I look at what rate expectations are now. I mean, I understand, okay, maybe the Fed will not raise rates, or at least they still are going to leave the door open or whatever, but there is a full percentage point of rate cuts being priced into next year. And correct me if I'm wrong, is it April or May? 92% chance or 90% chance, right around there, of the first rate cut, like in the spring of next year. That's only a few months away. I mean, in order for the Fed to start cutting rates, we actually have to have, inflation's still not at 2%. And economic data is going to have to be absolutely 100% atrocious. And I don't know about you, but we got weekly unemployment claims tomorrow here in the U.S. That's about as real time, employment data as we can get here in the United States. It's still supposed to be a paltry 220,000, which is a non-alarming number. So in order for the Fed to really start cutting rates in the next 6 months, we're going to have to see a really nasty turn in the U.S. economy. So my question to you, Chris, have rate expectations gone too far the other direction? The pendulum, Mark Chandler from Bannockburn, he called it the pendulum swung. It swung really far in one direction. Is it swinging too far in the other direction now? Yeah,
I think so. I agree. It's the May contract there, which we were pricing in 22 basis points, so about 90%. Which now, for May next year, we're pricing in 68% chance of a rate hike by that time. Yeah, so to get them cutting by 25 basis points in May, I don't necessarily think you'd have to see a really dark economic picture, but you'd have to have really strong confidence that we are seeing a cooling of GDP but also a re-establishment in the trend in inflation towards target, and then they can take maybe a tweak. But I think it's still too early. I think rate cuts are a second half story, at a minimum, on what we're anticipating. You go to June and we're pricing in 1.2 cuts for June. So, it starts getting a bit aggressive around those kind of times. And I think, is the market saying we're going to get rate cuts because we're going to get a recession? These are recession bets that people are putting on. Or is it more that, they're still going to contract their balance sheet. They're going to, QT is still going to happen when rate cuts happen. The Fed have made that known in the July FOMC that they would do this and concurrently. But they just want to take it out of a highly restrictive territory because they've now got confidence that inflation's trading down to target and they don't need restrictive Fed funds, and they're going to take it to a more neutral rate. I think the question is what is a neutral rate? The Fed seem to think it's 2.5%, but I think it's probably closer towards 3.5%, maybe a little bit higher than that point. So yeah, I think that the market is probably saying on balance that we're going to have greater conviction that inflation is trending to target. They're going to be doing QT and balance sheet reduction. So maybe they don't need a restrictive territory, and we're going to get rate cuts to bring it to a more neutral equilibrium state. I think that's what it's saying. Your other argument, of course, is how many people are in there betting of a recession and using the Fed funds or swaps market effectively as a hedge against that situation.
Yeah, it's a good point. Good point.
Yeah.
Anyway.
Well, I just think it's interesting. Apart from Australia and Japan, if you look at 1 year forward rates in the market, there's quite aggressive easing expected. It's going to be one of the stories of 2024 is are we going to get a recession in these countries? But are central banks going to ease policy? I mean, in the UK, certainly in Europe, they're pricing in sort of 3 rate cuts next year. In the UK, similar. So it's only Australia and New Zealand, Australia and Japan, that's not the case. Interesting one. Anyway, let's go to that 2024 outlook, because I think from a trading perspective, Blake, it's interesting. I was talking to a colleague and he's like, well, are you going to put out a 2024 outlook, based on your set of assumptions for the year? And I said, well, I actually, I read all the Morgan Stanleys and your Goldman Sachs and your JP Morgan outlook for 2024 on a multi-asset basis and, the economic trends. And for me, Blake, it's about their thought process and how they get to that rather than blindly coming out, Mike Wilson's got a price target of X. Because for me, that just creates biases, which we don't want in trading. And it's actually very much to your detriment. But how the logic of how they come to this, how they see economics playing out, how they, the sort of event risks that could potentially get. I find that quite interesting, and the thesis to get there, and that can help me manage my risk a little bit better. But price targets on yields or where they see economics, for me that just creates a bias, and we react as traders rather than actually try and hold on to something just because Morgan Stanley have said it's going to go to that. So in terms of outlooks, there can be some informational advantage because right now they're all producing them, and the media are putting out their forecasts and various fix. But for me, what we don't want to do as traders is create bias and hold on to it because it creates emotional attachment. So how do you see that?
Well, first of all, I look at research analysts and I look at their forecasts, and usually it's them trying to make a name for themselves. And for us as traders, it really is useless. And I have to agree with you. Understanding what they're seeing as the risks or the potential outcomes moving into next year is interesting reading for all of us. And I think it's worth reading as long as it doesn't allow you to cement some sort of bias in your head on a day-to-day basis. I do have a bias. I always have a bias, and I try to have that always in the background of what I'm doing. But that's also, I've got years and decades of experience of trading, so I don't let it necessarily influence what I'm doing intraday. Or even from a week-to-week basis. But I do like forecasts. I don't ever write them. Our company has never really done them because I think they're, ultimately it's just more of it's a kind of a silly exercise for us to do it as traders. But I do find it interesting, and I like to read them.
I think for investors, I think it's quite important because for investors, one of the most important things, of course, is your expected returns. It goes into the theoretical things like CAPM models and various sort of classic concepts in finance. But if you've got an assumption of your expected return, that can help you with your asset allocation. So that's where you'll go as a multi-asset portfolio manager. But for traders like you and I think the best thing, and we talk about it every year, is that in January, expect the unexpected. You've got everyone chasing into year end. We get the calendar, all these guys reset, and it's just on. And how many Januaries do you see? It just becomes crazy. And all these understandings of these theses of how 2024 gets blown out in the first week or so. So it's nonsense.
Upended. Yeah. It's interesting, but hey, I do think it's great it's great reading, and it's great entertainment for those of us that will geek out on it. So, all right, let's talk about the last topic, which I think this one I hold near and dear to my heart because of what we just witnessed this week. We had these massive outsized moves that we saw yesterday. And the question is, I like to ask, to chase or not to chase, Chris? And
that is the question.
My default answer is don't do it. If a market's gone too far, in your view, you have to think about where, like when I buy and sell stuff, whether it's, I'm buying or selling like a product or a watch or, an automobile or currencies or markets just in general. I think about where things were just moments ago and where they're at now. And so if the S&P has just rallied 10% in 3 weeks, I realize I'm paying a 10% premium versus somebody that was buying S&P a much smarter price than me 3 weeks ago. Am I willing to pay that premium in this environment? And that's when I start asking those types of questions. So I do that with currencies. I do that with equities. And that gets me and it prevents me from chasing. Do I miss trades? Sure, I do. Yeah, absolutely. I've been in situations where I'm like, I'm not buying it. And it just continues to run higher. That's okay. Trades are like buses. If you're waiting at a bus stop, there's going to be another one coming by. Don't worry about it. But I don't like to chase. So what's your default in a situation like what we've seen today? Do you counter trend or over the last couple of days? Do you counter trend? Do you trade in the direction? Do you believe this move is going to continue? What are your thoughts on this idea?
I mean, I think I wouldn't counter trend. I don't like to step in front of this, to be honest. I mean, there are ways people do it very successfully indeed, probably more from a sort of mean reversion sort of standpoint rather than just say, oh, this has gone too far. You've got to look a bit more sort of statistical, using various measures to get that point of maximum stretchiness. Yeah, I like to buy into this, to be honest. I like to buy into weakness. I think that gives us an opportunity. I mean, we take the classic momentum. For me, I subscribe to momentum. I like to buy what's strong, sell what's weak, and I think the tech trade is very much that. So the best momentum indicator you can have is a rate of change. Just to stick it on a 2-day rate of change, that tells you the vector that is, and I like that. So I think when this kicks up, you go along for the ride. And just hope that the active guys are going to push you up there, and you've obviously got the zero DTE guys who are causing that as well, and in terms of flows. So I like to buy into that trend, swing trading, whatever you want to call it. But for me, breakouts are good, and anything going up I want to do. So I think this year it's going to be growth, it's going to be momentum, which carries you to the end of the year. And Nvidia, I think, is an interesting one. They've obviously got such a decent weight on the Nasdaq. They report next week. So, if you look at the implied volatility in Nvidia, it's kind of 7.8%. So the market's expecting big movement up or down. And so, if we get a good set of earnings, and you've got a CEO there who knows how to please investors. I know, he's a guy who just hits the market sweet spot every single time. He knows what works, whether it's AI or various other factors. He just hits the market at the right time and offers value to shareholders. So we'll see what happens there. But if Nvidia go, the Nasdaq would take another leg up. But look, we've run a long time. It wouldn't surprise Blake now to see a bit of consolidation here. We'll see what happens with rates markets as well. But I prefer to chase using a more sort of momentum strategy, if you will. There we go. Anyway, let's go into the charts that matter. Let's go into that's the setup. All right, I'm going to bring up the old classic, Mr. Euro Dollar. It's really like through November, Blake. It's really just been a case of just sell the US dollar and just buy whatever you want to buy, whether it's Mexican pesos, whether it's Aussie. Stocky's been the place to be. The Swedish krona has just absolutely gone for it. Maybe you can speak to that, but the Stocky's been good. Going to LATAM, we've seen some huge moves in the CLP and some of the sort of less liquid currencies there. But it's really just been a case of what do you want to buy against the US dollar? And look, Euro dollar's been obviously well traded, and you saw that big move up that breakout. But we've come back to test former trend resistance. We came into the 38% retracement level of that recent sell-off that we saw, and it's just sort of just hovering and consolidating around that level. I actually want to sell it a little bit higher structurally. I know that's sort of going against that sort of momentum thesis, but that's more sort of a fundamental view there. How are you trading the euro dollar there, Blake?
Well, that's a great question. One of my setups for this week was actually to short the euro around these levels. And so I have initiated some shorts in the euro because this is where I wanted to be involved on the short side. Do I think there's a little bit of upside in the euro? Perhaps. I think that we might be able to probe 109. And I think dips down to 108 are going to be supported near term. But tomorrow, as I pointed out, and this is going to be obviously after the show has been aired, we're going to have weekly unemployment claims here in the U.S. And we also have, some other data that's going to be out at the same time. And I believe that data is going to continue to show, signs of strength. And if that's the case, the euro dollar is probably going to be trading back below 108 again. So it's interesting how you pointed out the underside of that trend line being tested. If you take the dollar index, we're testing that inversely around the 104 level. And so as long as the dollar index remains above 104, which is above the 200 DMA, I still believe that the dollar is a buy on dip story right now.
I'll tell you what, so next week it's a very light week in terms of data next week, but the ones that stand out for this pair is we're going to get preliminary S&P global manufacturing numbers and service numbers, PMI data, PMIs, in the Eurozone and also in the US. And that matters. This data point does matter, certainly the service numbers. This is the first print. So we'll see what happens there because, we could see a resurfacing of US exceptionalism coming through that pushes there. But the other factor is, we don't get proper big data in the US now until December. So, you're going to get payrolls come out on the 9th of December. We get the US CPI number on the 13th of December. So we're going to get these data points, these growth data points, but the big one, they don't come for a while. So that's an impetus. But I think going into 2024, that rate of change on balance sheets, whether it's the Fed or the ECBs, that favours the US dollar strength. So we'll see what happens there.
All right. Well, we're going to stay in the euro world and let's move over to my first setup, which is going to be the euro sterling. And, it's interesting. I saw the euro sterling back off the 87.50 level yesterday pretty aggressively, almost set up like what I would think is a double top. But because it's been bought so aggressively on dips, it looks like we're setting up a bullish wedge. Now, bullish wedge means that there's a higher probability of us breaking higher than lower. Doesn't mean it can't break lower. But if I had to put numbers on it, and I always tell people I'm not a statistician, with all the charts that I've seen in, decades worth of looking at charts, I would say that there's probably a 65 to 70% chance of an upside breakout and a 30 to 35% chance of a downside breakout. But we have UK data coming in early Friday morning, which is going to be retail sales out of the UK. The data out of the UK this week has been somewhat mixed. I think we saw, a tick down in CPI, but a tick up in PPI. The average hourly earnings, I believe, was a little hotter than expected. But if that retail sales is a miss, and you see that as a miss, going into early next week, we could push right above here and make a break for the 88 pence level, which is the 618 retracement. And then it takes us right into the PMIs. But what do you think about this euro sterling here as we consolidate in this wedge?
Yeah, I think those PMI numbers are going to dictate because, again, you've got a situation where the rates market, swaps market has said, both central banks are done. There's going to be, we're not pricing anything for either central bank, and the next move is going to be down, but it won't be until sort of mid next year. I think it's those service PMI numbers next week, which we get both in the UK and Euro, which is going to be a fundamental driver, and that will cause potentially a difference in the trend. We'll have to see what happens there. But which way does it go? I love the way that you're thinking in terms of distributions. Where does it come? And you're assigning a probability. That's how the options market works. That's how we should be thinking about the path of least resistance. And I think you're right. I think if I was to do that, I'd say that your probabilities are probably on the money. I favour this to the upside just because of the flow of capital. But we'll have to see. Positioning's obviously another thing. The world's obviously pretty short of sterling at the moment, as they are euros. So that's another factor. But yeah, I like this to the upside. But yeah, I think your probabilities are spot on there. Another one which we bring in. Let's bring in Sol, because I know there's a few crypto heads in the room. We talked about expected returns. Well, crypto has changed people's expected returns, going from 8% a year, where you're going to get in your super, to one where you can get 8% in a day, quite easily, or 50% in a month, maybe more. But, Solana's an interesting one because they're caught up in the whole sort of FTX situation where they're selling, the coins effectively, but the stocks, or Solana's still had a massive move. In fact, I think since 12th of October, despite people looking at this sell down of coins from FTX into the market, they're up 212% or so from mid-October, which is a staggering move, obviously. And I think it's caught a few people off guard. So, we're talking about this idea of chasing. I mean, well, when we talk about FOMO, there is no asset class, if we want to call it that, that exudes FOMO better than the crypto space, and certainly in the altcoins here. So, Cathie Wood came out with a pretty compelling reason why she's buying Solana at the moment, why she thinks it's going to outperform. And I think maybe that's caused some additional buying playing through. But this is hot right now, Blake. Really, really, really hot. And I quite fancy this going higher here. What do you think?
I mean, it looks great. I mean, the thing is, I was looking at where like the 38% retracement comes in. I mean, that it seems to me, and I'm not a crypto head, but it looks like we have further upside. Where are we trading right now? At 65?
65, yeah. But I mean, if the interesting thing, if you actually, I've taken it into a short-term chart where we've obviously gone from about $20 to 65. But if you take a longer-term chart, you can see when this goes, it can be incredible. Of course, what we saw a couple of years ago was this 88% collapse. But this, when you actually look at it on a longer-term chart, you've got this big move down, and this move that you see here is just like a little blip, effectively. So, when this thing goes, it can rip.
And the 105 levels, the 38% retracement, based on the chart that I'm looking at in front of me. And you got this so much momentum behind crypto right now with Bitcoin, Ethereum, both that look very constructive. Why can't Solana, continue to rally? I have to say though, if you are trading this, you just got to manage your downside. You don't want to obviously going the opposite direction, because just as fast as they can go up, they can obviously reverse too.
Well, so, if you're chasing, you got to be prepared to cut it pretty quickly, I think, because it can go down in that situation. You just don't blindly hold it. I think Bitcoin, we talked about it last week, and that's held up pretty well. And I think we go back through 38,000. I think we make new highs, and obviously, whilst the spot ETF seems to have been delayed a little bit, I think there's the Bloomberg analyst who's been on the money has coined a 90% probability that it's going to happen. So I think that's how much of that's in the price, but. I still like this scene higher at the moment. I think Bitcoin goes higher.
Sell the news. Sell the news, Chris. Sell the news. Buy the rumor, sell the news.
That's it, mate.
All right, let's take it to my next setup, my second setup, which is Amazon. So, do you guys have Amazon in Melbourne?
Wait, you're joking.
No, I'm not joking. I don't know. I have no idea.
Yeah,
Amazon's everywhere, right?
And we've got canals as well.
You do? You have canals? Hey, look. I love Amazon as a retailer. I do. I get so many packages throughout the course of the week from Amazon. But what's interesting is we're trading around the 618 retracement. We put in almost a bearish outside day. One of my colleagues brought this up to me today from Forex Analytics, and I'm like, holy cow! The fact that we couldn't take out that 618 retracement, the fact that we closed lower and have a bearish outside day. I think while Amazon trades below 148, you got to look on the short side. And if you want to stick it to Bezos, this is the way to stick it to Bezos. You know where your risk is. And look, if you think the market's gone a little too far, a little too fast, you have stocks like Amazon that might take the lead if we get some sort of retracement. But I have to also point out that if you look at a weekly candle, it's setting up potentially, if we close on the lows for the week, keep that in mind, we'd have a gravestone doji. So what do you think about Amazon here?
Well, I'll stick it to Bezos. I'm going to show him. I'll short a touch, send it to Bezos. I think he'll be gutted. I think he'll definitely think that he'd been stuck it to. So we'll see. I don't know. Look, I think it's an interesting one. It's been so hot, and the hedge funds love this one. It's a darling up there with Meta and Nvidia and other places. So this is one that is well owned. But I think if you're looking at candidates which are going to be useful for the chase into year end, well, Amazon's going to be one of those that would definitely get the attention if we are going to see it happen. But that price action is quite interesting. I didn't see the news, but it does seem that there's a bit of supply, a bit of offload coming into that one. So we'll see. Do we get that follow through selling, which could encourage a few people, a hot market, an over-owned market, just to take a little bit more off the table and come down to that sort of orange moving average. So we'll see. I'm not going to short it myself, but what we've seen there is just the start that a few people are just taking a little bit off the top. But as I say, when I'm looking at this idea about chasing into year end, and there's still a bit of time. Obviously, we sort of that typical really strong period comes in sort of December 15th, that kind of area. If we're going to see the market chase and use stocks, not just S&P and Nasdaq futures, Amazon's one that you're going to do. You're buying winners. What's worked this year? Amazon's worked this year. Netflix as well. Meta's work this year, Nvidia's work this year. These are going to be the candidates that people are going to chase into year end, I think. So we'll see. Are you shorting them now, Blake?
I'm thinking about it. I'm really, really thinking about it right now, but I'm not sure yet. So
Bezos is going to be gutted.
I have to say, you I know Chuck Bezos would be gutted. Hopefully he doesn't see the show or shut down the Amazon cloud service on us today. So let's hope not.
So, anyway, let's go to play of the day. Let's see what's on mind. I'm gonna try a cheeky China trade this week. What we've been seeing, if we have a look at the China H, which is the H shares effectively, so this is a market that's out in Hong Kong, but there's a sort of a mixture between Chinese mainland companies and Hong Kong companies, and we've seen the PBOC adding very, very strong levels of liquidity through the medium lending facility into the markets, into the capital markets. But you've got this two-tier economy in China. One, which is the retailers are spending more now. We've seen that in the retail sales numbers, but it's the property space that's really concerned. We saw measures yesterday to address that, making cheap loans and liquidity available to property companies through the pledge supplementary facility. And I think, is that the panacea? Absolutely not. But they want to just ring fence this and slowly grind this and make it add some confidence into this area. But I think what we're seeing now is that we will see rate cuts this year. I think we're going to see a reserve ratio cut. They're doing good stimulus now, lots of liquidity. The market likes it. This is a very unloved market, a very underowned. And the moment that I start seeing inflows through the northbound connect, we saw some yesterday, then I think that would really incentivize people to be in these stocks. Tencent's come out some fantastic earnings. I think that's going to be a good place to be as well. I think if we're going to see melt up into year end, I think we're going to see it in this market from an under-owned market. The other big issue is obviously the US dollar. There isn't a market which is more correlated really and benefits from a weaker US dollar than Hong Kong and also the H shares and the Chinese markets more broadly. That would encourage inflows into Chinese equities. You are kind of at the mercy of the US dollar a little bit with going long China. But we've started to see early signs. I think this is a candidate that could do well going into year end.
All right. Well, Chris, thanks for pointing that out. My play of the day is going to be the dollar MEX, and I'm actually looking to buy this dip. I do want to mention that the euro yen was my play of the day last week. It reached 163.40 as we were talking about. I already stepped into it on the short side. It is kind of going parabolic, which does concern me just a bit, but I'm still in just a small position. But the the dollar MEX, what you'll notice is it's trying to complete a double top which should extend us down to the 78% retracement. The 78% retracement comes in right around 17. Now, what I think is developing is a triangle consolidation. Keep in mind that Banxico has changed its program, and it's reducing a lot of the liquidity it put in since COVID. And so what you're going to see is natural Mexican peso selling as a result. So I believe a dip down to 17. I'm going to be looking to be on the long side. I'm not long yet, but I am buying the dip in this pair because I think once the double top is done and the 78% retracement is tested, you're going to see my bid down there right around 17, Chris, and that's going to be my play of the day.
It was short Amazon. Use the profits there to buy dollar MEX and sail off into the sunset. Happy man.
There we go.
There we go. Anyway, to all you viewers, thank you very, very much indeed for sticking around. I hope that you've got something from the show. Let us know how you're seeing the world, the sort of setups on your radar. We do really like to see those, and if you want to sort of jump in with any kind of trade ideas that you really fancy, we'd love to entertain those as well. It'd be good to see. Anyway, thank you very much, and we'll see you back next week for more of the trade-off.